Welcome to this video on the topic, Why is volatility skewed? After completing this video, you will be able to refresh your concept of implied volatility. Review the BSM model's flat volatility assumption and explain the reason for the existence of skew, as well as the shape of the skew.
There are broadly two types of volatility: historical volatility and implied volatility. Historical volatility looks at past data and calculates volatility in the past. Implied volatility tries to gauge future volatility using present data. Let us understand the volatility surface graph now. Implied volatility is usually shown on the y-axis of the graph. The x-axis is the strike price of the options. For illustration purposes, the underlying asset is priced at $5,000, which makes the strike price of $5,000 at the money. Assume that the implied volatility is 20. Black-Scholes model for option pricing assumes that the implied volatility for options with the same underlying asset is constant. Thus, the implied volatility will be a flat line, as shown on screen. For the volatility surface, we plot the implied volatility of out-of-the-money put options on the left and out-of-the-money call options on the right. Since we assume constant volatility, let us try to find the options prices using the BSM model. For a strike price of $5,000, which is at the money, the option call price is $66. For a strike price of $5,010, which is out of the money, the option call price is $61. Similarly, the call price for a strike of $5,020 is $56. On the put side, if the strike price is $4,990, the option put price is $61. For a strike of $4,980, the put is priced at $56. You can see that if the out-of-the-money options are at the same distance from the at-the-money strike price, then their price is the same.
But this was before 1987.
What happened on Black Monday of 1987?
Markets around the world faced a steep decline. The Dow Jones Industrial Average fell 22.6% in a day.
Thus, the option sellers who had sold FAR OTM puts were forced to honor their agreements and faced huge losses. After 1987, traders were ready to pay a higher premium for OTM options to cover their positions as well, assuming the implied volatility for OTM options was higher. From then, option sellers demanded a higher premium than normal for OTM options. Thus, the implied volatility line is now not a flat line, but rather a curve. A curious effect is that for equities, the call IV for OTM options is less than the put IV of OTM options. Here, the curve is skewed on one side, leading to the name volatility skew. In equities, the put IV is usually higher than the call IV. This is because traders assume there is a higher chance of the equity asset going down than going up by the same magnitude. And so they pay a higher premium for puts. In contrast, gold portrays an opposite skew. This is because gold is considered a backup and a surge in price is expected more than the decline.